This LOS is describe types of financial intermediaries and services that they provide. Financial intermediaries. Financial intermediaries help entities achieve their financial goals. These intermediaries include 1. Commercial, mortgage, and investment banks, 2. Credit unions, 3. Credit card companies and various other finance corporations, 4. Brokers and exchanges, 5. Dealers and arbitrageurs, 6. Clearinghouses and depositories, 7. Mutual funds and hedge funds, and finally 8. Insurance companies. Now in the text, this is one section where there are quite a few pages of text with regards to the description of each of these financial intermediaries. Now, this is just meant to be a review slide. I do encourage candidates to go back and skim through and see if anything pops out in the text. Just taking a quick screenshot of my ebook. And so again, as I said, this is meant to be a review slide, so I'm not going to go through a description of all the different financial intermediaries. But again, just wanted to show you that it's also good to just skim through and look at any of the examples in the blue boxes. So the first one that we see under this section is brokers and dealers. Which characteristics most likely distinguish brokers from dealers? Now, this is not a multiple choice question, but you could see how it could very easily be turned into a multiple choice question. So there's some good factoids in the blue boxes. So the solution is brokers are agents that arrange trades on behalf of their clients. Think of a yacht broker, okay? They arrange the trade between the owner of a yacht and, who's selling and a buyer, okay? They do not trade with the clients. In contrast, dealers are proprietary traders who trade with their clients. So that's a big important difference between brokers and dealers. Brokers are agents, dealers trade directly with their clients. Scrolling down now, we can see there's another example with regards to commercial banks. So what services do commercial banks provide that make them financial intermediaries? So the solution is commercial banks collect deposits from investors and lend them to borrowers. They are intermediaries because they connect lenders to borrowers. Commercial banks also provide transaction services that make it easier for the bank's depository customers to pay bills and collect funds from their own customers. The next example in the text is with regards to dealers and arbitrageurs. With respect to providing liquidity to market participants, what characteristics most clearly distinguish dealers from arbitrageurs? So this is an important one. Dealers provide liquidity to buyers and sellers who arrive at the same market at different times. They move liquidity through time. Arbitrageurs provide liquidity to buyers and sellers who arrive at different markets at the same time. They move liquidity across markets. So you can see that's excellent material for an exam question, that dealers provide liquidity who arrive at the same market at different times. They move liquidity through time, but arbitrageurs provide liquidity to buyers and sellers who arrive at different markets at the same time. They move liquidity across markets. And we'll just finish this LOS to show you that there's one last example in the end of this section with regards to financial intermediaries. So it says, as a relatively new member of the business community, you decide it would be advantageous to join the local lunch club to network with businessmen. Upon learning that you are a financial analyst, club members soon enlist you to give a lunch speech. During the question and answer session afterwards, a member of the audience asks, I keep reading in newspapers about the need to regulate financial intermediaries, but really don't understand exactly what they are. Can you tell me? How do you answer? So it gives you a nice little solution here with regards to financial intermediaries, companies that help their clients achieve their financial goals. We saw that at the beginning of the LOS, and it gives an example about the commercial bank, an insurance company, and those are two examples of financial intermediation. Many others involve firms engaged in brokerage, dealing, arbitrage, securitization, investment management, and the clearing of the settlement of trades. So again, my final point here is just there's a lot of factoids here, so not a lot of value add by going through a lot of time in the slides reviewing it, but you just need to go through, review the sections, and then most importantly, look at the summary and the end of chapter questions, the practice problems, and see, do as many practice problems as possible. Okay? And that's the last for this LOS. Thank you.